Hello students, I'm Shyla, Assistant Professor and Head of the Department Business Administration. So today I'll be giving you a brief introduction to accounting and the basic concepts of accounting. So before moving on to accounting, we'll just see what exactly bookkeeping. Bookkeeping is nothing but recording of business transactions in accordance with the principles of accounting. But it's only a recording process which is done in a primary book called journal. So then we'll move on to what exactly is accounting. Accounting is one step ahead of recording, which is broader than bookkeeping. So this goes with identifying, measuring, recording, classifying, summarizing, analyzing, interpreting, and communicating the financial information to the needy people. So what exactly this identifying refers to? We need to identify these transactions in order to record in the books of accounts. So you can identify the transactions which can be measured in terms of money. So those transactions which cannot be converted or which cannot be measured in terms of money will not find a place in the books of records. Okay, that's a basic step. We need to identify and then measure the transaction, whether it is possible for that particular transaction recorded or not. So once it is recorded in a book called journal, which is called the primary book of entry, we'll move on to the classification process. So what happens in the classification process is all those transactions which are of similar in nature, all those accounts which are of similar in nature are classified into various groups. So this is what happens in classification, and this is done in a book called ledger. And then further it will be move on to summarizing. So what happens in summarizing is we find the results of the business. That is, whether the business has earned some profit, has incurred some loss, is assessed with the help of summarizing process. And this is where we come across the preparation of final accounts of a business, like your trading and profit and loss account and the balance sheet. Balance sheet is prepared to assess the financial soundness of the business. So once it is summarized, then we'll analyze and interpret the data. So what happens in analysis is we group the data onto some methodical classification is done under analysis part. So why this methodical classification is, which helps in interpretation. Interpretation refers to based on the solvency or based on the liquidity or based on the long-term solvency or short-term solvency of the business organization. This is what is assessed or done under analysis and interpretation. And finally, the results which are analyzed and interpreted will be communicated to the people who are in need of the information with respect to business. It could be the stakeholders like shareholders or general public or whoever is interested in the financial information of that particular business. So this whole process or the functions are called the basic functions of accounting. Okay, so after that we'll move on to the principles of accounting. So this is nothing but when you want to enter the transactions in a book, you need to follow certain guidelines. Okay, otherwise it's not possible. So these guidelines or the rules are called the principles. Okay, so generally it is called as GAPs, that is generally accepted accounting principles. This is nothing but, as I mentioned, these are all the guides to action. So these principles are further divided into concepts and conventions. So what is this concept? This is again the fundamental ideas or the basic assumptions behind recording the business transactions. So one thing you need to keep in mind is these concepts are mandatory in nature. It's not choice, like you can choose this particular concept and leave some. All these concepts are mandatory whenever the transactions are recorded in the books of accounts. So there are many concepts which we come across. So to list out, we have money measurement concept, separate entity concept, going concern concept, cost concept, dual aspect concept, matching concept, accounting period concept, realization concept, and accrual concept. So I'll give you a brief introduction about each concept in a simple language so that it will be easier for you to understand. So let's start with the first one. It says money measurement concept. So what exactly money measurement concept? As the name itself says, it is money measurement concept. That means any transaction which can be measured in terms of money will find a place in the books of accounts. That means what? The qualitative transactions which cannot be measured in terms of money is not recorded in the books of accounts. Only those which can be measured in terms of money will find a place. Okay, that's about money measurement concept. So moving on to the second one, that is separate entity concept. As the name itself says, there is two terms here. One is separate and the other one is entity. Okay, separate is individual and entity is individuality. So what exactly refers to this concept is, so whenever a business is started by an individual or an institution, so any transaction which is related to an individual should not be mixed with the business transaction. Say for example, if I have started the business and I have paid some amount towards my life insurance, then the amount that I have paid towards the life insurance should not be recorded in the books of accounts of the business. So both transactions should be kept separate. This is what is meant by separate entity concept. So you will record all those transactions which are exclusively related or meant for business. Only then you will be in a position to arrive at the correct picture at the end of the year when you analyze the results of the business. Clear? So moving on to going concern concept. As it says going concern, it doesn't mean that the concern keeps on going. So the presumption here is the business, once the business is started, it will continue for quite a long period of time. So there is no intention to wind up the business at the immediate future. If you don't assume this, then what happens, whenever you invest in a business, you cannot classify certain expenditure as capital expenditure and certain expenditure as revenue expenditure. So I'll explain it to you what exactly capital expenditure and what is revenue expenditure as I move further. Okay. So this is what is meant by going concern. That means a business is assumed to have a long and perpetual life. That's what the concept says. So moving on to the next one is cost concept. So as the name itself says, it is related to the cost part of an asset which you purchase. So whenever we purchase a material or an asset, we always record that particular asset on the basis of the cost which is paid and not on the market price. Because you know that the market price keeps on fluctuating on a day-to-day basis. So you cannot keep on changing the same price how it changes in the market. So it's always safer to enter or record the asset at cost price so that it's easier for you to calculate the depreciation in future. Okay, so the next one is dual aspect concept. As the name itself says, dual refers to double. Okay, so any transaction will have double effect. Dual means double, two effects. One is debit and the other one is credit. So what is this dual effect refers to? You should be knowing the accounting equation, that is capital plus liability is equal to assets. So any transaction if you take, it will have one as a debit effect and the other one is the credit. This is what is dual aspect refers to. You need to follow this particular concept in order to record the transaction in the books of accounts if you are following the double entry system of accounting. Okay, moving on to the next one is matching concept. As the name itself says, it is matching. If you want to analyze or if you want to calculate the profit or the loss that the company has suffered in one particular financial year, you need to match your expenses with the incomes. Say for example, I have earned around 1 lakh rupees as my income, then I need to check how much I have spent. That is my expenses. So only when I compare my income with the expenses, I will be in a position to analyze whether I have earned some profit or loss. Say if I have earned 1 lakh, my revenue is 1 lakh rupees and my expenses is around 50,000, then I have earned a profit of 50,000. Otherwise, the other case, like if my expenses are 1 lakh and my income is only 50,000, then I have incurred a loss of rupees 50,000. This is how it goes. And moving on to the next one, accounting period concept. So as the name itself says, it is accounting period. So I mentioned that under the going concern concept, the concern or the business organization will have an perpetual, there is no end for the business. But if you want to know whether the business is going on a right path, whether you are continuing the business on a right path, you need to assess the business based on the profits that you are earning. So for that, you need to have a break. Say for example, one accounting year like 12 months. So at the end of 12 months, you will sit and summarize all the transactions and find out whether you have earned some profit or incurred loss. If at all you are incurring loss, then you need to know where exactly things are going on and where you can correct yourself. If you don't do that, then one side you'll be continuing your business without knowing whether you are earning profit or incurring some loss. So the intention behind accounting period is you need to break down the life of the business into your convenient period and assess the financial results. Okay, that's the intention. And moving on to the realization concept here. So one particular transaction or sale or purchase will be termed as realized only when it is realized in terms of money. Okay, all those outstanding or any dues will not be considered. That is what is realization concept says. And the last one, accrual concept. Accrual concept, you need to bring it to the record of the books of accounts even if it is outstanding. Say for example, you are supposed to pay rent of rupees 50,000 rupees every month to your landlord or the owner of the building, and you have paid for 10 months and the remaining 2 months you have not paid. So you should not show that only 10 months rent you have paid and the 2 months you don't show anywhere. Even if you have not paid, the 2 months rent should be shown as outstanding rent when you are closing the books of accounts at the end of the financial year. Clear? So these are all the concepts. As I mentioned earlier, these are all mandatory in nature. Okay, there's no choice. So once you are following the accounting principles and if you want the accurate results from the business that you're carrying on, you need to follow all these concepts mandatorily. Okay, that's about the concepts. And moving on to the convention, this is just exactly opposite to what we discussed now. This is not mandatory in nature. These are all nothing but the customs and the practices. Okay, so there is no universal applications when it comes to the conventional part. Of course, this again left to the choice of the business or the people, those who are maintaining the books of accounts. But once they follow this, it will definitely improve the accounting, improve the quality of the accounting information. Okay, so there are basically 4 conventions which are mentioned. That is convention of materiality, convention of conservatism, convention of consistency, and convention of full disclosure. So we'll see what exactly convention of materiality refers to. As the term itself says, it is materiality. So we record only those transactions which are significant in nature. So significant refers to which are quite noticeable. Say for example, the clerk or the accountant, if he has purchased a pencil or an eraser, if you feel that it should be brought into the account, then it's fine. But usually what happens, only material transactions or significant transactions are recorded in the books of accounts. Okay, this again, as I mentioned, this depends upon the practice that's been followed in the organization. If the organization is very particular about each and every transaction which should be brought into the books of accounts, then they will do it. If it is not, then they can go for it. Okay, that's why it comes under convention and it doesn't come under concepts. I hope I'm clear. So moving on to the consistency, as the name itself says, consistency. So once you adopt a particular method, you need to continue with the same method. Say for the best example is the depreciation. So once you fix up a particular method of depreciation which is to be applicable to a particular asset, then the same method should be followed year after year. Say the first year you follow straight line method and the second year you cannot switch over to reducing balance method. Clear? So once a method is adopted, that should be continued till the end. That's what the consistency says. And moving on to the third one, convention of conservatism. So this conservatism refers to, so as per this particular convention, they say that you need to provide for all possible losses, okay, but expect no profit. It says that. So what does it mean? So thinking about the future, to face the uncertainties in future, you need to create the reserves and keep in advance so that your profits will not get affected in future. Okay, it's nothing but the prevention is better than cure. So on that on that basis, this particular convention, again, this is not mandatory. As I mentioned, this depends upon the policy of the organization. If they feel that there should be a reserve, like you must have seen, reserve for doubtful debts, reserve for discount on creditors, all these things, if they feel that it needs to be maintained in the organization, it's fine. Otherwise, it's not mandatory. Okay, and the last one, full disclosure. As the name itself says, all material facts related to the business organization should be disclosed. in the form of financial statements. So the financial statements, what we prepare at the end of the financial year, all the information, all the material facts must be disclosed in that particular statement, because that information will be kept open. That is, it will be meant for the public, so that the whoever prospective investors can go through the information and invest in the business. Okay, this again, it's not mandatory, as I mentioned. Okay, that's about the principles, the concepts, and the conventions. So we'll move on to the classification of accounts, the most important under the process of accounting. So without knowing the classification of accounts, you cannot pass the journal entry. Passing the journal entry is nothing but the recording process, which is the basis or the first step in case of accounting. Okay, so the accounts classified into three major categories. One is personal accounts, and the second one is real accounts, and the third one is nominal account. So what exactly personal account here refers to? So this personal account is, these are the transactions which are related to person. So the person again can be classified into three major categories. Okay, so it can be natural person, or it can be an artificial person, or it can be a representative personal. Okay, so what is natural? As the human beings. Okay, so like Ram's account, or Kumar's account, or Sushil's account, that's what is natural personal account. And artificial refers to, say, the institutions, companies, banks, okay, charitable institutions, all these comes under artificial. Okay, which doesn't have the life, but still it comes under the personal classification. And the third one, what is representative personal account, is which represent an individual, or it represent an institution. So the best example is, say for example, as I mentioned in the previous case, outstanding rent. So 2 months rent you have not paid, but which is due. Okay, maybe it is due to your owner, or to some other institution from where you have hired your premises. So what is this representative refers to? All these outstanding. That means what? That amount is due to a person. It can be an individual, I mean natural person, or it can be an institution. It comes under representative personal account, which represent a person. Like outstanding rent, outstanding salaries, or outstanding income, outstanding interest, all these things comes under representative personal account. Okay, so moving on to the second one, I mean rules for this personal account, let me just make it clear. So you need to debit the receiver and credit the giver. So that's the rule that you need to follow when you pass the journal entry with respect to personal accounts. Fine. So we'll move on to the second one, that is real account. This is nothing but asset account. Okay, so this is nothing but the properties, or the assets, the business which is carried on with. It can be a tangible asset, or it can be an intangible asset. So tangible refers to which you can see, which you can feel, which has a physical existence, like your furniture, buildings, or machinery, all these things. And intangible refers to which you cannot feel, or which you cannot touch. Say for example, like your goodwill, your copyrights, okay, your patents, all these things are intangible asset, but still it has a value. That's the thing. And the rules for this is debit what comes in and credit what goes out. So whatever comes to your business will be debited, and whatever goes out of your business will be credited. That's what the rule for the asset account or the real account. So after that, we'll move on to the third category, that is nominal accounts. Okay, so nominal account refers to, this is a revenue account. So we come across incomes and expenses here. So all those revenue incomes and revenue expenses are taken into consideration. So the rule for this is debit all expenses and losses and credit all incomes and gains. So this basically we find it in the profit and loss account. So this is about the basic rules and the basic classification of accounts that we have learned. So moving on to the next one, we'll see what exactly, as I told you that I'll be touching upon capital and revenue. So what exactly is capital and revenue? First we'll see what is capital expenditure, revenue expenditure, and then we'll move on to capital receipt and the revenue receipt. Okay, so capital expenditure, what exactly is? Usually whenever we start the business, we incur some huge expenditure, maybe for the acquisition of land or a building, or for purchasing the machineries, all these things. So you know that the amount involved while buying these kind of assets will be quite huge. The intention behind is, so once you invest in such kind of expenditure or asset, so the return from that particular expenditure will give you over a period of time. Say for example, whenever you buy a building or machinery with the intention of starting a business, the returns from that particular investment or capital expenditure, as I mentioned, will be spread over a period of years. Okay, it can be 10 years or 20 years or 30 years, depending upon the durability of that particular asset. So capital expenditures are usually incurred for acquiring the assets. So usually it will be huge amount, and definitely which increases the earning capacity. And whenever you invest or incur huge expenditure, you need to charge depreciation. Why the depreciation is to be charged? Because so once you acquire an asset, you start using it, is it? So as you go on using it, there wear and tear and passage of time, so the value of asset will go on decreasing. So every year you need to write off some percentage of amount on the cost which you have purchased the asset as depreciation. There is nothing like there is a outflow of cash involved here. Okay, this is only a book adjustment to write off the value of the asset every year. This is what is called as depreciation. So this is again one of the important feature of this capital expenditure is non-recurring in nature. That means what? You incur only once. It's not that every year you go on incurring this capital expenditure, but you incur only once in your lifetime. I mean, unless you want to change the machinery, you invest once and continue with the business. So that's what about capital expenditure. And moving on to the revenue expenditure. Revenue is nothing but which you incur on a day-to-day basis. Okay, like routine operations. So usually this is incurred for a short period of time. There is nothing like you charge any depreciation for that. So for the smooth functioning of the business, for operating the daily business, whatever the expenses that you incur, like your salaries, your interest, your discount, okay, the rent that you pay, all these things comes under revenue expenditure. Clear? So there is a clear distinction between capital expenditure and revenue expenditure, as I mentioned earlier. So after that, we'll move on to capital income and revenue income. So whenever you invest in some huge investment, say for example, you invest in some shares or you invest in some huge projects, okay, definitely you will be earning some returns from that. Okay, so whatever the income that you get from the investment that you make, that is what is called as capital income or capital revenue. So whereas revenue income is which you receive on a day-to-day basis, which are recurring in nature, whereas capital is non-recurring in nature. Say for example, after 15-20 years, you want to dispose the machinery and go for the new one because you have got some totally a new machinery which is quite advanced compared to the machine which you had purchased almost 10 to 15 years back. So when you sell the machine, definitely you will get some proceeds, right? You get some amount out of the sale. And so whenever you sell the capital assets and you get some returns, the returns whatever that you get, the money whatever that you get out of the sale of this fixed asset, it what is called as capital income. Whereas the revenue income which you generate on a day-to-day basis, like you receive interest, you receive discount, you receive dividends, all these things are termed as revenue incomes. Okay, so these are all the basic things about the introduction to accounting. And further, the second unit will be moving on to what exactly the subsidiary books, the journal entries, how to prepare the journal and how to open a ledger and how to post the entries from journal to ledger, and what are those subsidiary books, how many classifications are there, all these things I think we'll be taking up in the next unit. Thank you.